bank account penetration is the one metric that has been most often used. And as you probably know, there's been a huge increase in banking penetration in the world globally. So globally, in the last 5 years, we've gone from 52% of 15 years and older globally to around 68% globally. So it's a huge increase, mainly because of India and China has added a lot of new people on bank accounts using digital distribution primarily. So in both those countries, around 200 million people each have come online the last 4 years because of digital distribution, as an example. So access to bank account has been the classical way of defining inclusion. And exactly, and your definition, access and use is kind of the official way of doing it. Now, when we looked at that, we felt that something was missing from that definition. Because it's not, sometimes you have a lot of adoption or penetration. So on the left-hand side, in South Africa, 70% of the adult population actually has a bank account. So at face value, if your only metric was, do people have bank accounts, you would say that South Africa is a fairly well-included population because 70% actually have bank accounts. The problem being that many of those have been given a bank account from the employer or from the government. And most people are uncomfortable, many people are actually uncomfortable using bank account to pay or do transactions. And as you can see, almost 1/3 of the population withdraw their money immediately and have a cash economy, like Sonta in the beginning. They have the money in their mattress, they hide it at home. They are mistrusting the financial services players to keep their money. And they've all heard stories about banks folding, people losing their money. So there's a deep fundamental perception gap between the population and the financial services sector. So obviously, penetration or adoption is not enough to measure, because if that's the only thing, South Africa would be quite high. Now, usage is not, we don't feel that's enough either, because if you look at South Africa, most people actually have some sort of insurance, and most people in the lower LSM segments have funeral insurance, which is a very basic life cover, term life type policy, super basic, and actually very expensive for people as well. So if you look at that, 8 of 10, you would also say that South Africa looks quite included, but we know that more than half of the cars driving on the street out here are not insured. We know that most people don't have P&C or non-life or short-term cover, etc. And we know that people pay a lot relative to their income. People pay a lot for their insurance in the lower end segment. 12% of the disposable income goes to paying some sort of insurance. So we thought that actually penetration or adoption and usage is not enough either. You have to look at true sustainability as well. So the new way that we are looking at this is we have the 4 products as you see. Transaction accounts are typical bank accounts where you get a salary, where you pay bills. Credit is loans, insurance, both short-term and long-term, so both life insurance and property and casualty insurance. And then you have savings. So we looked at those 4 categories of financial services. And the basic is adoption. How many bank accounts do you have? What part of the population actually have insurance, etc. That's kind of the basis of the definition. Then we say usage is important, but definitely not enough. And the last layer is that it has to be sustainable for all players in the ecosystem. So we're saying it has to be long-term affordable for individuals. It has to be profitable for the companies providing the services long-term. And it has to be in a regulatory environment that is acceptable to avoid mis-selling and to avoid exploitation of uneducated consumers. So the whole ecosystem must be sustainable for us to say that you have true inclusion in a country.